The video that you're about to watch is an excerpt out of a 3-part training program that I put together for the Digital Scale School Group. So this is a 32-minute simple P&L. There's then a 29-minute intermediary P&L teardown. And then there is a final 20-minute expert level P&L with the template Excel that I mentioned in this video. So if you want access to these 3, I'll put the link to the school community in the description below so that you can join and watch the intermediate and expert videos. But let's dive straight into the simple one. In this video, I'll be running through a simple P&L breakdown so that you can have an introductory level understanding of how the P&L works and how finance ties into marketing. Now, going down financial operations and getting a better understanding in this space is quite a difficult thing to do. It's not easy to go and learn financial operations, and particularly how that ties into marketing and the levers within the ad account. And so I want to make it very clear as to why we're even doing these videos and why this series even exists, because you're going to go and put a bunch of effort in to learn this stuff. And you might be wondering, well, why do I even have to put time and attention here? Because if you want to become the best marketer possible, the best operator possible, the best CEO within a larger organization possible, you need to be able to allocate your attention effectively to learn skills that you're currently deficient in and bring them up to a level that's satisfactory to then move to the next skill. And so the question you need to ask yourself fundamentally is, if you're a 9 out of 10 right now on Google Ads, how much benefit is there in you going to a 10 out of 10? Or is there benefit in you sidestepping to another skill, call it financial operations, and how that ties into marketing decisions, and take yourself from a 1 out of 10 to a 3 out of 10? What's the better decision to make here? Now, that's going to be very contextualized within your particular goals and your career pathway and what you're looking to do, but it's a question that you should be asking yourself, and it's a question that I'm going to provide a little bit of context on right here, which is that a marketing win, unfortunately, does not often equal a financial win. And I'll give you a few examples of this before we actually dive into a P&L structure and explain the basics there. But an example, and the easiest example in the book that everyone uses this day, is ROAS. Return on ad spend does not necessarily equal revenue and profit. And instead, the better metric here is MER. MER takes total revenue and divides by spend rather than taking attributed revenue, because attributed revenue has all kinds of issues with it. It can over-attribute, it can under-attribute, doesn't take into consideration bottom of funnel and middle of funnel. For example, the end of the funnel will always get better attributed ROAS than the top will, and so it might misalign your incentives of how to actually grow the business, and obviously the list goes on. But this doesn't just tie into ROAS and the original typical go-to here, but it also ties into incrementality. And so when you're looking at optimizing for marketing, a very often KPI that agencies will be given, and I see this particularly in larger 8-figure brands, is that they'll KPI themselves around traffic. And the reason why they can KPI themselves around traffic is because if you assume conversion rates hold, or maybe you even put a linear regression model that it reduces, or even you logarithmically say, hey, as we scale traffic, conversion rates are going to go down accordingly, then we can use traffic as a parameter to know how much marketing spend we should then put in to get a revenue target outcome. Now, the issue is when you start KPIing around traffic or around ROAS, around any of these marketing-related metrics, you start getting marketing-related outcomes that don't necessarily drive increased profit. And so you need to change the way that you're KPIing so that you have financial outcome wins, which you can then work your way back into the ad account to then generate in-platform KPIs. Now, that might all sound like a little bit much. And so let's move up the screen here and let's start to dive into what a basic P&L looks like and why this understanding is important. And then obviously you'll have the intermediary and the advanced videos where we'll go a lot more detail. We'll actually break out the P&L, common things to look for, and then how it all ties into levers within the ad account. And so anytime you're going to look at a profit and loss statement and let's just restrict to e-commerce brands for now, but this applies to any business, is you're going to get an export from a financial software. Could be QuickBooks, could be Xero, multitude of other financial softwares, and it's going to look incredibly complicated and not make a lot of sense. And there's a couple of reasons for that. Number one, it isn't structured intuitively in a way that aligns with using marketing as a primary driver for revenue. And number two is that it's split based on the way that the bookkeeper or the accountant is reconciling accounts. And so you will have revenue up the top, and revenue will generally be decomposed into all of the relevant sales channels. Now, for e-commerce, there really should only be one, but there might be a line in here for your direct-to-consumer revenue, and there might be a line in here for your B2B revenue if you have an omni-channel presence and two components here. Then you will have all of your expenses, and this is where things get a little bit complicated, because depending on how the bookkeeper wants to approach it, you can have hundreds of line items here. You might have a line for advertising, and this might be split even further. You might have Google advertising, Facebook advertising, influence advertising. They all might be separate lines. And then in here, you're also going to have everything else. So if you're writing off car expenses will be in here. If you have food will be in here. Rent will be in here. The list goes on and on. Every single expense related to the business. And then under here, you will then have your profit figure, which, once again, we're keeping it very simple in this video, is just going to be your total revenue minus your total expenses. And so you're going to have an idea, okay, with all the revenue that came in and everything that we paid in this particular time period, how much profit did we make? And that's the very simplistic view of looking at a P&L. Now, in this format, this is helpful for almost nobody, because we can't look at a P&L in this structure and really derive many insights. There can be a few things. You can go, well, you're spending too much on your car, remove that. Well, you might be spending too much on ads, because we can do a basic MER calculation here, and we can derive some kind of insight there. But we're not going to get really helpful contextualized insights by looking at the P&L in this structure. And so I would strongly recommend that it is restructured. And how I would restructure is like so. And I would recommend doing this in a Google Sheet or an Excel sheet. Is firstly, you want net sales. Now, technically, you want net sales plus shipping collected. And this is if you're getting an export from Shopify. And now the reason being is that a lot of internal business discussions end up being orientated around very different sales figures. So you want to be talking in one consistent sales figure so that you can have consistent marketing KPIs across the board that stack up. For example, I've come into businesses before where they're orientating on a 4 MER, but then I do the math based on net sales and shipping calculations, and they're running on a 3.2. And I'm asking the question, well, you're currently on a 3.2, you think you're on a 4, where is the disconnect here? And the reason why there's a disconnect is because they're calculating the MER figure, including taxes. They might not be removing the discount figure, so they're actually using gross sales within Shopify. And then in addition to that, they're adding their B2B revenue in as well. And so I need to know how you're actually composing this revenue figure to calculate the core KPI before we can start putting any kind of KPIs in place. And so my recommendation for anyone that doesn't know, well, what revenue figure should I choose? Should I choose net? Should I include taxes? Should I not include taxes? I personally don't like including taxes. I think it's a flow-through expense. I don't believe it should be an actual expense calculated in any type of percentage gross margin or percentage contribution margin figures. And so I would take net sales and then I would add shipping collected. And this is the shipping collected at checkout. And then you would have your figure here. And so let's call it $50,000 during this time period that we're looking at. Cool. The next section here is your cost of delivery. And so this is all expenses related to the creation of the product, the delivery of the product into the country where you're housing it, and then the actual delivery to the end consumer. And so this is including, obviously, cost of goods sold. But this is where most people stop. And so they'll stop at maybe cost of goods sold comes out at $10,000, and then they're on to the next and they call that gross margin. It's a very common error that will often lead you into a position where you'll drive a business into single-digit profit figures, and they thought they were closer to 15 to 20%. And the reason being is because there's also transaction fees in here. And now transaction fees are typically about 2.3% plus 30 cents per order. And so we can do just a basic 3% flat rate assumption here, just to keep it simple. And that's a relatively safe thing that you can always do. And so that will be 1.5. And then you might end it there. But then there's also shipping and fulfillment fees. And so this is at a per unit level, and you want an average cost. And this is something that you should always be able to get from clients, or if you're an internal brand watching this, you should know this figure off the top of your head, which is on average of the 1,000 orders that we fulfilled last month, how much did we pay to our shipping courier, right? Maybe we spent $10,000. They invoiced us for those 1,000 orders. Okay, this is a basic division, 10,000 divided by 1,000, which means our average shipping and fulfillment fee, and yes, my writing isn't great here, shipping and fulfillment fee is coming out at $10. And so we do $10 times 1,000 orders, and you know what your shipping and fulfillment is coming out at. And so for this sake, $10 for an average product, it's pretty on point. If I'm going to give you an average across the industry, it's probably closer to $8.50, but let's assume $10 for easy math there. And let's assume that this wasn't 10,000 orders and this was actually 500 orders. And so this would be a 5,000 expense. You can see why these two line items become so pivotal in this gross margin calculation. Because if we didn't include shipping and fulfillment, we would be getting a very different figure here. And so now from here, we actually want to add in a difference. We don't want to go and list all of the expenses, and we just want to take a break and figure out what our gross margin is. And so you would want to be including this in your Google Sheet. And this would be as simple as $50,000 minus all of these expenses, which comes out at $33,500. Now, once again, most people orientate the entire P&L within dollar figures. Dollar figures isn't actually that helpful when you're trying to get a quick glance and do an analysis. And the reason being is, okay, shipping and fulfillment. Oh, look, if I look at transaction fees and I'm trying to quickly contextualize, is this high, is this low? I don't really know because I don't have percentages broken down. And so I would also recommend that every time you build a P&L, no matter how it is structured, you add an additional column in, which has all of the percentage figures. And so I want to know how much is cost of goods as a percentage of total revenue. How much is transaction fees? How much is shipping and fulfillment? And then how much is gross margin? Which this is double 33, so this is 67%. This is a solid gross margin, or right about where you'd want it. And then we're going to go into the second level of expenses. So we have cost of delivery, which is the first bucket of expenses it's going to outflow from a business. The next is direct advertising, and marketing. Now this, if you're a marketing agency or someone that works on Google and Facebook ads, this is what you're going to be in control over within the P&L. And so let's say we've spent $10,000 here. So this would be 20%. Which then, once again, we're going to take a break and we're going to sum up and find a new line item here. So we've got our gross margin, and the next line that we're going to find is what's called our contribution margin. Now, you'll hear this term thrown around a lot with a lot of different meanings and definitions, and that's because underlying contribution margin, there's actually three definitions. There's contribution margin 1, contribution margin 2, and contribution margin 3. And people will just throw the term, and I do this all the time, contribution margin, and assume that you know which one I'm talking about. And it's contextual to the individual brand and how you generally approach calculating this figure. Contribution margin 1 is the same as product margin. And so we've technically actually already calculated CM1, which is gross margin right here. Contribution margin 2, which is what we're calculating now, is all of your cost of delivery minused off, plus your advertising and marketing has been minused off. And so this would then come down to $22,500. this percent we would need to double, so this would be 45%, I believe. Actually, it would be as simple as 67 minus 20, and so this would take us down to 47%. And then contribution margin 3 is actually what we're not going to call it. And we are instead going to call it net profit. But this is where you now have operating expenses, or often shortened to OPEX. And this is anything else within the business. That's the easiest way to think about operating expenses, which is that it's not anything to do with the cost of delivery, the manufacturing, or the delivery of the product. It's nothing to do with advertising and marketing. So this is anything remaining. Now, within a direct-to-consumer e-commerce brand, this typically lies into 3 core buckets. Number 1 is people. Number 2 is office and warehouse. And number 3 is software, or SaaS. And so this is pretty much going to encapsulate 80 to 90% of operating expenses in a business. And so let's remove that and put in an assumed figure here. And so let's assume that operating expenses for this business is $10,000 per month. Which then brings us all the way to the end, which is our net profit figure, or also sometimes called EBITDA if we're not including depreciation and amortization above this part of the P&L, but that's more at an intermediary and an advanced level, so we're not going to include that in this video. We're going to stick to net profit as a very simple figure, which comes out at $12,500. Which is 25%. As I mentioned previously with the contribution margin 1, 2, and 3, if you were going to use those kind of definitions, this would be contribution margin 3. And so if you're ever using the term contribution margin, or you hear other people using it and you want a clear definition, I would ask whether they're using 1, 2, or 3. And if you're ever using it, I would strongly recommend just using it in the context of CM2. In my opinion, it makes no sense to use contribution margin to define gross margin when everyone understands the universal terminology of gross margin, and the same thing for net profit. Everyone generally will know what net profit is. It's a more universally used term. So using contribution margin 3 generally isn't a productive term to use, but it does cause a lot of confusion in the space. And so when we're zooming out, and we're going to move over into an Excel sheet in a moment so you can see what this looks like in a lot cleaner fashion without my handwriting. This is what the P&L should look like, and this is how you should be looking at it, which is that you have net sales up the top. You then have cost of delivery, which gives you a gross margin figure. You then have your advertising and marketing, which gives you a contribution margin figure. You then have OPEX, which takes you down to net profit. Now, how does all this tie into marketing? Why are you learning about a P&L structure within a marketing-based video? The reason for this is because you have to know what the gross margin is of a business to have any idea what you can spend on advertising and marketing. That is just a baseline requirement. And the reason for that is that we can further simplify this down into just percentage points. And so we can go, you have sales, which is obviously 100%. You then have cost of delivery. You have marketing. You have operating expenses. And you then, down the bottom, have profit. And so the percentage outlay here is going to indicate how much profit percentage is actually left down the bottom. And so if your cost of delivery is, for example, 50%, and now you go and spend 20% on marketing, well, 100% minus 70, we've only got 30% left in sales revenue to flow through into profit. And so let's say they run on lean operating expenses. Fantastic. Well, they end up at 20% down the bottom here. Now, the issue is, what if cost of delivery is actually 60%? But you didn't know that because the client only gave you COGS. They didn't give you transaction fees, and they didn't give you shipping and fulfillment. So it's actually 60%, but you only put 50. Well, then if this is actually 60, we lose 10% off our assumed margin down the bottom here. And they're actually going to end the year at 10% and wonder what happened, right? We budgeted for 20% marketing. We budgeted for 10% operating expenses. We budgeted for 50% cost of delivery, and we ended up in a subpar position that we didn't originally plan to be in because we didn't know our numbers. Now, you might be thinking, well, that's the business owner's fault, right? They need to know their numbers. You'd think that's the number one rule of owning a business. But the reality is that if this is a business, honestly, this applies to anyone, but if this is particularly a sub 8-figure business, I almost guarantee they don't know their numbers to a T. And so if your job is to drive the best financial outcomes possible and scale up their marketing and scale them as a brand, and you're looking for a case study even, you need to do your own due diligence. You need to look at the figures themselves, and in a very ideal world, you need to understand how to do an export of their actual P&L and be able to look at all of these expense items and pull them together and be able to group them into, well, what of all of these hundreds of expenses is cost of delivery? What of them is operating expenses? And what is marketing? And then how can I then bundle those out, figure out the percentage allocations so that I can understand how much to allocate to marketing? Because the reality is that, and this is very common, particularly with brands that are stocking or retailing other products, is that you might be in a position where this cost of delivery figure is 70%. Now this business no longer works because profit drops to zero. And in fact, I see this quite a lot. I've seen this in a lot of businesses, which is that this operating expense is actually at 20. And this MER is at 10. And so the business is running on 0% profit and wondering, how do we get more profitable? They come and approach us, and they believe that the answer is make marketing more efficient. Let's drop MER down to 5%. Let's get a 20 ROAS as opposed to a 10. And I can tell you with a high degree of confidence that that is not the solution here. Trying to scale a business off a 5% allocation to marketing when you're in the direct-to-consumer space is physically impossible, and you have chosen a bad business model, or you have chosen a bad way to structure your allocation of sales into these 3 expense buckets. Instead, if I'm going to give feedback to this exact brand and tell them how they should actually be structuring, I would be telling them, we need to allocate as much money as humanly possible to marketing so that you can get your sales figures as a dollar figure as high as possible to be able to democratize operating expenses in proportion to top line revenue. And what I mean by that is that they might be sitting at 10K in operating expenses. This might include a small warehouse and 1 staff, or it might include their own salary. They might be doing 100K in top line revenue. They need to get their revenue to 200K so that OPEX drops to 5% as opposed to 10. And the only way to get revenue up, the only way to double revenue is to increase marketing, because this is the key lever to increase top line revenue, to therefore decrease the percentage of operating expenses and open up profit. And so marketing, in my opinion, if I was to say, hey, here's how you should structure this P&L, marketing should be 20% here. Operating expenses should be 5 to 10. You have a tiny trickle through of profit, which is going to allow you to de-risk the position of the business and account for any error that might exist here. And then only once you've achieved scale can you look at cutting back on marketing and bringing this down to 15% to 10%, etc. Once you have a high existing customer database and you have returning customers, it's also helping to prop up revenue. But you do not, biggest mistake I see, you do not want to decrease MER. The solution generally isn't to decrease allocation towards marketing. The solution is to spend as much as humanly possible on marketing, stay as lean as possible on operating expenses, and then also over time, try to change your product portfolio to have better cost of delivery as well. And the only way that you can have that discussion with a client, the only way that you can start talking in this way and actually understand why this is so important and be able to counter pushback, because right now, obviously, it's easy for me to sit here and talk, but no one is sitting here pushing back on any of the points I'm making. If you mention this in a call with a client, you will get heavy pushback on all of these things. And so you want to be able to sit there confidently and argue this point, which is why it's so important to understand finances. It's so important to understand how the P&L is structured so that you can begin to have these discussions and argue why we should be allocating 20% towards marketing in a business that only has 30% gross profit. And then this also layers into KPIs, which is, okay, now how are we actually KPIing performance? And there are a lot of different points within the P&L where you can start holding towards North Stars and key performance indicators that we can then back propagate into the account, And so the first one is contribution dollars. If we know that operating expenses is $10,000 a month, we know that we need to generate at least $10,000 in contribution margin to be able to have the business as profitable. And so we can then follow and track contribution margin on a daily and a weekly basis to make sure that we're on track to have a profitable month. You can also obviously hold contribution margin as a percentage, as an accountable figure. And so this is really just holding you accountable to keeping MER stable while still maintaining volume. And so you're through KPIing on contribution margin, you're KPIing on both maximizing for volume and also maximizing for efficiency. Whereas often you end up maximizing for one or the other and not both. The other reality, and this starts to get a little bit more complex, is that cost of delivery does not remain stable on a month-on-month basis. This percentage and this figure will actually change almost every single month. And it will change in accordance to discounting. And so if you start to sell products at a discount, your cost of delivery as a percentage will go up as you'll be yielding less revenue in proportion to the amount of cost of delivery that's within the business. And so therefore, your advertising and marketing KPIs actually have to change as this percentage either drops or increases. And therefore, your contribution output changes as well. And so understanding how cost of delivery is dynamically changing on a month-on-month basis through being able to do a basic P&L export is really important too. And so here's what this looks like once you take out my bad handwriting and put it into an Excel sheet, which is, these are all the figures that we were just looking at, and I've just encapsulated it into November. And so we have net revenue, we then have cost of goods, fulfillment, transaction fees, we come down to gross, we then have direct advertising and marketing. Note that this is just your in-platform spend and any influences that you want to tie into here. This is not any contractor expenses related with production or ad costs. I would always recommend putting anything outside of direct advertising expenses into operating expenses. Why? Direct advertising and marketing will proportionally arguably increase faster than the rate of revenue growth. And that's really important to understand, particularly when you're looking at a P&L, because what you want to know is that if we were to double the business next month, how much money do we make in EBITDA? And if you are going, okay, well, double revenue equals double operating expenses, and operating expenses includes direct advertising and marketing, and this is all looped into one bundle, you're going to double everything, which isn't going to be accurate. When you double a business from 50K to 100K, particularly in the direct-to-consumer e-commerce space, you shouldn't really need another employee. You shouldn't really need a larger warehouse. You shouldn't really need any more software products. Like, all of these things should stay stable. And the only thing that should realistically increase is marketing expenses. And so you want to make sure marketing expenses are separated out so that you can model in increasing in advertising and marketing and keeping everything else flat. And then watch how the percentage splits across the board change. And that's why I always recommend too that clients restructure their actual P&L within their software, within their accounting software, so that they get marketing split out from operating expenses. And we have a video on this right here. It's called How to Fix Your Ecom P&L Report, and it dives into that exact process of pulling direct advertising out from your operating expenses. And then from here, we have all of our correlated percentage figures too. And so this allows you to go across the month and continue to track these metrics, and then obviously have a percentage breakdown down the bottom. Where this starts to become really useful is obviously for troubleshooting why profit might decrease in a particular month by looking at percentage allocations across the board. but also for mapping out what future growth could look like. And so in particular, a business like this might have $20,000 in operating expenses, and a 5 MER is quite aggressive, so they might actually be sitting somewhere in this position. And let's not have this as green if it's negative, so let's switch this around. Transaction fees remain stable. So then we come out with slightly more gross margin. We come out with $3,000 more in contribution margin, which takes this business into profitability. And now this obviously scales exponentially as long as operating expenses remain stable. And so this ends up becoming a really good tool to be able to drive a business into profitability and orientate around actual financial metrics that are going to drive better business performance. Whereas previously, the solution here, particularly from a business owner interacting with a client and recommending them on the changes that they should be making, and so the agency ends up being reactive rather than proactive, is the client will come to them and say, hey, we're losing money at the moment, which means we need to spend less on marketing. Drop the marketing spend. And so then you go, okay, we need to drop marketing spend. They're obviously losing money, so we have to. So you go and drop marketing spend by $2,000 because that's the losses that they're taking. So they're like, we need to cut this somewhere, so let's cut it out of marketing. They drop by $2,000, but that loses us some top line revenue. And so maybe we don't lose a lot, but let's say we lose $3,000 in top line revenue. Well, then now we're actually in a worse position. We just took a step back rather than a step forward by cutting spend. That's why cutting spend is not the solution. And the only way to demonstrate that cutting spend is not the solution is to understand this basic P&L and be able to walk people through it and have an understanding that direct advertising and marketing is what's generating the top line. And so the solution to profitability generally is, yes, increase efficiency of current spend, but also spend more so that we can drive incremental returns on top line revenue, which is going to grow bottom line and put you in a better position.